Here with me now is Michael Kantrowitz. He's the chief investment strategist at Piper Sandler. It's great to have you here.
Thanks. Good to see you.
And what a juxtaposition to Friday's better than expected jobs report, but you would say today matters more?
Well, it's why we need to look at a breadth of data. And there's about literally 30 different data sets we look to corroborate all of the employment, especially the most popular stuff like payrolls.
Right, exactly. So we already talked about how continuing claims are pointing in the wrong direction. Now we have kind of new jobless claims. But how much time do we have? It's been the most telegraphed downturn and hard landing, at least since the Great Recession. Is it going to be as bad as that one? And how much longer till stocks start pricing in more of that in?
Yeah, from history, you generally see that the broader markets, so we're talking about the S&P, right? The S&P's done well year to date. Microcaps and small caps have not. Value stocks have underperformed. Cyclicals have underperformed. So parts of the market are reflecting the increased risks. And that's why I think a lot of money's rotated in some of those big cap quality growth stocks. So it's happening. It doesn't happen at the index level really until people believe, investors believe and see that we're entering a recession. And I think claims need to go a bit higher from where they are here. And I think we'll see that later in the back half of the year.
Or obviously a negative payrolls print, then, forget about it. Of course, we're not quite there yet.
Yeah.
Also worth pointing out that you saw this dispersion after the bank crises, where we really started to see smaller companies underperform. What does that tell you?
Yeah. It's interesting because a lot of people attributed that to people moving into tech and moving out of financials, but it's far broader than that. We've seen literally in every one of the 11 sectors, larger companies outperform smaller companies within small caps, within value, within growth, literally all the size and style benchmarks. So it's more than just people putting money into tech and away from financials. It's people putting money into fundamental attributes that they have visibility on and have strength. Companies that have strength, good cash flow, balance sheets, and avoiding areas that are more cyclical, more risky, more leveraged. So I think, it's easy to say, well, it's tech versus financials,
right.
But the same types of attributes, like I've mentioned, are working or not working in all parts of the market. So it's bigger than just those two sectors.
And it seems to indicate there's a real fallout from kind of tightening bank lending for those companies more exposed to that. Maybe they're starting to underperform. There's two things as well when we talk about hard versus soft landing. I always think, you bring two specific things that could help us get a soft landing that maybe we're not seeing right now. So I was thinking about it with the loan officer survey and also thinking about with regard to housing. Just explain how those two variables can tell us just how hard this landing might be.
Yeah, so we have our framework of, it's cutely called HOPE, housing orders.
Should be called no hope, by the way.
Well, it's hope on the way up and hope on the way down.
True.
And that stands for housing, orders, profits, and employment. So last year we saw housing and order data start to really come off. And now we're seeing profit expectations, especially for the riskier parts of the market, start to come down. And employment data, I think we're in the first inning of seeing that deterioration. So the conditions of every recession since 1960, there's been 8. There's 3 preconditions. The Fed hikes, we have an inflation problem, and we have tighter lending standards for banks. We have all 3 of those conditions today.
Right. So if the banks come out and reported that actually they were easing lending standards, so that was fine, then you might say, hey, we could still have a soft landing, but we're not seeing that.
The thing is that everyone now is very aware that banks have been tightening lending standards. They've been doing it for over a year.
Totally.
This is only added to that. It's like saying, yes, a couple of weeks ago, the Fed just raised rates. Well, they've been raising rates for a year. I would have been shocked if they eased lending standards in today's backdrop.
What about housing, where some people might say, but hey, look, the spring, prices are better than expected. There's still bidding wars. There's still a lot of demand here. What does that tell you?
So at the end of every Fed tightening cycle, and there's been 12 since 1960, at the end of it, near the end of it, as interest rates peak, mortgage rates, you always see a housing bounce, and you always see housing stocks do well. And that's one of the reasons that people think generally when the Fed's done, we're going to see this soft landing. What determines whether or not we go into a hard landing is actually not about housing. It's really more about employment. And if we see deteriorating employment, what we always see is that housing bounce, which today I would argue it's a bounce, not a bottom, rolls back over as people lose jobs.
And so that's why this employment report jobs claims is really so important.
Yeah.
Do I even ask you about the debt ceiling? I mean, your framework is like, this is cyclical. That probably just makes things worse if we come to some sort of problem there.
Yeah, our policy analyst thinks that they'll get something done before the X date. It's not part of something I can frame out with historical analysis and have as much conviction.
Yeah.
So, I think ultimately we're all speculating on this, so it's not really part of my process.
Although I should mention, because we're sort of having a little bit of a Kroger sub-theme to the show, you guys always still have places you think you can be long, a short basket. In your long basket right now, Amazon, Kroger, Visa, General Mills, Merck. I mean, there's definitely a grocery and value tilt there. Sells would be Caesars, Western Digital, Ingersoll Rand.
Yeah, there's attributes where money's always moving towards. And since we're not at the point where claims are rising enough and employment's panicking investors enough to cause a big market downturn, money's moving into quality areas, defensive areas where there's stability and safety. So those types of names rank well in that model. And that's where we would continue, and I think investors will continue to pile into as we see the market narrow further.
Absolutely. Michael Kantrowitz, thank you for your time today. Appreciate you coming over.